Welcome to Creative Insights, the workshop for financial advisors, insurance professionals, and fiduciary consultants. Today's workshop, Why Manage Mortality Costs? Part 4 of our 5-part series entitled The Power of Tax-Free Retirement Income. In this segment, we're going to talk about how to build and design a life insurance contract that's really efficient and effective. So we're going to be looking at the cheapest way to mitigate our costs and to use our loans in a proper way so that we can really compete heads up with almost every product that is anywhere between mid to long-term investment horizons. I want to talk about 3 basic regulations that impact it. I came into the business right during this time. So many things changed. One of the first things that changed was the 1982 TEFRA Act, the Equity and Fiscal Responsibility Act. This changed the way we take money out of products. So all of a sudden, we used to be able to take our basis out first and then our gain, first in, first out, but then they flipped it and now we have to pay our gain first and then we get to recapture our basis, which doesn't have any taxes to it. So this really changed our planet. One of the few exceptions to this rule is the amortization of a lifetime payout with an annuity where you get the exclusion ratio, partial principal return, partial gain, so you get part of that up front. And the other is using life insurance in a TAMRA compliant contract. There's an exception to this, I'll get to it in a second. But really, we can take withdrawals of basis out. So it's really critical. This rule, even though there was a huge imposition to most financial products, we had a few exceptions on the life insurance side and the annuity side. In 1984, the DEFRA law was installed. The Deficit Reduction Act, well, that was a hopeful dream back then. The DEFRA changed the way we use life insurance. In the old days, and especially with younger advisors, they're astounded by this. In the old days, we actually could have an accumulating cash value that exceeded the death benefit. So if you bought a $500,000 worth of death benefit and you were doing an accumulation dividend, like on a par whole life contract, that actual accumulation of cash could supersede the death benefit. Everything above the line would be a taxable event. But they changed that and introduced this thing called the DEFRA corridor, the distance between cash value and the death benefit. And generally, there's some long number, but it's basically, you're talking about a 15% corridor that the cash value and the death benefit can never meet until the endowment date or the maturity date. So during that time, during that quarter, during the life of the contract, that quarter has to be maintained. So the difference between the death benefit and the cash value, that corridor, and because of that, you're only paying the net amount at risk. So if I can bring the corridor down day one by designing the least amount of life insurance, I'm going to do that. And back in the day, we could drop it to 15%, the spread between the cash value and the death benefit, and it was great. The cost was negligible on the net amount at risk. But then because of how cool that was, and we were really using this, in fact, people made careers off selling single premium whole life because of that great idea and because it was a great deal, they introduced in 1988 the TAMRA, the Technical and Miscellaneous Act. This changed our way where we had to stage in, not only do we have the DEFRA quarter now, but we have to stage in our money based on the guideline 7-pay test, the guideline annual, and the guideline single. 3 new impositions, so we can't just stuff money in there. If we put too much money in too early, then we create a modified endowment contract and we lose the tax-free policy loans. And that became a big issue on how to artfully stage in premium so that we could avoid TAMRA. Now, when I'm selecting the lowest cost of insurance, I'm thinking about selecting the gender first. And in the last decade, in cases that I've been involved in, I have not written a male client. Why? Because I usually can find either the spouse, the female spouse, or maybe even somebody within their family, another female who has great health. All I have to do is remember that I have to have justification if I use somebody outside the marriage. So if it's a daughter, it's a son, I just have to justify the insurance. And remember, I'm buying the least amount of insurance possible under the code. Generally, that's not going to be a problem. So I'm looking at gender, and there is an age crossover where you're going, you know, it's not worth doing the income any longer, depending upon if you keep it. Usually I'm going to say probably a male 55 older than that, holding it for 20 years and taking out way late in his 80s, I don't know if that's really a good timeline. I'd have to do the math. I'd prefer rather going down to the next generation, because then the client can still own it, they can control it, they can contribute it, but it's based on a timeline that's much cheaper and a lot less expensive on the cost of insurance. But I have to look at gender, I look at age, and then I look at underwriting classification. Remember, some of our top companies that are really great, that illustrate great rates of return, cannot do any kind of what I would call creative and benevolent underwriting. So unless your client's really top of the line preferred or whatever, you're not going to get a good number, and that cost of insurance is going to go up. So certain carriers, if I know I'm going to have a problem and I can't use a surrogate, I'm going to go to certain carriers because I know they're going to be benevolent, more benevolent than maybe my lead carriers that I would normally pick strictly on the basis of product. Now, when I came into this business, you were either a smoker or a non-smoker. That was it. We didn't do anything that we're doing today. For example, in the non-smoker category, which is really the only category I want to use for income, I'm looking for the best cost of insurance. If I use a smoker with a pipe, a smoker with tobacco, it's just going to cause problems because I have greater expenses, because the timeline of a traditional smoker with traditional tobacco is less than a regular non-smoker. That's going to make the cost higher and my rate of return on my investment less. I'm looking at these. Look at this. This is so astonishing. I came in, it was just standard. Then they added a little bit up, kind of an uptick discount. You get a little discount on your cost of insurance to go to Standard Plus. Then we went to Preferred, then Preferred Plus, and now Super Preferred. Huge discounts. If you don't think this matters, you should look at the term spreadsheet, whether you're looking at iPipeline or you're looking at EBIX's term Vital Quote. Any of these will show this. You can map these out and put them side by side. There is a disparity in the term market, shockingly, where you could go from first place to the 25th place and there'd be a 20% difference in premium. So shopping the right to see what kind of benevolent underwriting is going to be a really major issue with income. So I'm always looking at this, and of course my goal is female, super preferred, young as I can get it, because those numbers are going to be great when I put together this contract. I'm going to manage the minimum death benefit from the get-go. I'm going to purchase the TAMRA minimum death benefit, and I'm going to have to look at the selection. Am I going to use the guideline annual, or am I going to use the CVAT test, the cash value accumulation test? The cash value accumulation test is predicated on guaranteed pricing inside the policy and guaranteed crediting. Sometimes it's better to use the CVAT, or the cash value accumulation test, to get the numbers down, to get the cost down so much that I can really have great performance in the contract. Again, I separate always performance from the actual product expense. And if my goal is to make my product expense the least, I'm going to look at both of these. So when I'm doing a contract, I'm going to look at the male and the female. I'm going to look at the guideline annual and the CVAT. I'm also going to look at level versus increasing death benefit option, and I'm going to look about switching options to see if I can get more money out of it. And later on, I might still be able to, once I pass the guideline corridors, I might be able to drop the death benefit again and switch my options before I go to distributions. All this management of the cost of insurance by bringing it down will give me the most optimal accumulation and my most maximum distributions that I can get. And remember, we haven't even talked about the crediting method yet. I'm just talking about building and designing the best illustration possible. Our goal is to generate tax-free withdrawals of basis, and be careful, again, the force-out rule, the Technical Corrections Act in 1980 came back out and said, if you have gain during the first 15 years of a contract, and remember, because we're suppressing the death benefit so low, it's possible that you could actually have a force-out when you take a withdrawal. To avoid that, anytime in the 15th year, during the first 15 years of any contract, I'm going to take policy loans to mitigate that. But if I can take it, I'm going to do it, because withdrawals to basis is a great deal. Now, collateralized policy loans of gain. Remember, again, you're getting a loan from a contract based on the assets in the policy. It's collateralized directly to the policy. If you ever look at a carrier's front page of their summary sheet of the convention blank, their financial filings they have to do in every state, you'll notice that they'll have policy loans listed as an asset. So they're looking at that. That's an asset because you took a loan, but they have the actual cash assets on it. And if you were to die, they would just take the loan off the top of the death benefit, because that's what's collateralizing it. And then on top of it, I'm looking at maturity endowment dates, because this really matters. I can't have a contract terminating at age 90 on a super preferred when I know that the odds are very high according to the 2001 CSO as well as the 2008 Society of Actuaries relative risk tables that my client's going to blow by that age 90. I got to be very careful on what's the maturity date, what's the language. Some contracts don't even use maturity dates any longer. They use the life of the client. So I guess if the client decided to be the Guinness Book of World Records, Jean Clement, who lived 122 years, 164 days, that contract would be okay as long as she was alive. But make sure that you're looking at the maturity date or the endowment date, which depends upon the product, and to make sure it's far enough out based on their health and their timeline and their historicity inside their family, because some people have huge mortality. Grandma didn't die till 96, 97. So you want to look at all these issues because they really matter. Now, from an illustration internal rate of point of view, I want to kind of show you this because this is kind of another idea, kind of getting a look at it. Now, I've broken down the basic page off an illustration again, and I'm just using a typical index contract. I'm looking at what the internal rate of return. I really don't care about the death benefit. I'm sure there's some beauty to that, but I'm really looking at during my first 20 years, I credited on this count to the new AG 49 regs. So this is already compliant. We've already done that. And we're using, based on this carrier, we're using 7.43. That's their maximum cap that they can use under the new regs. So I'm illustrating that. So my first 20 years, I'm actually making 5.56%. So it cost me a little under 200 basis points all in for those first 20 years to manage this. But when I start to take money out at age 65 and I start taking money out, you'll notice that I'm with the arbitrage, and again, the regs have only allowed us to put 1 point over whatever current we're actually crediting to it. So now I'm sitting at about the high sixes, and I start coming into the early 70s. When I get around mortality, I'm getting right around 7%. So if I'm crediting 7.43 and I'm getting around 7, I'm sitting anytime during this timeline and distributions, I'm going to be well under 150 basis points, and in some cases, 50, 60 basis points in total cost to keep this online. So this is why it's so important to make sure that you're looking at expense loads like this, because this, to me, is when you compare things, in my view, in a very fair and true way. So when I'm looking at the illustrations that I just showed you here, I want to look at the basic ideas that will help you form and design and be an architecture of the best life insurance policy that you can do. This has been part 4 of our 5-part series entitled The Power of Tax-Free Retirement Income. For more information about the subject matter in this workshop, just email me at ssavant@creativeone.com.